Innovate, accelerate, move technology forward. The startup revolution is now.
Good afternoon, good morning, everyone. My name is Roland Marco Garcia, and I am the CEO and managing partner of the Embiggen Group. Essentially, this morning, this afternoon, we're going to talk about corporate venturing. Right, this might be a new term for a lot of people, but this has a lot of advantages in terms of corporate innovation and how startups can actually engage corporations using this model. Right, I'm also an adjunct professor at the Asian Institute of Management. I teach corporate innovation strategy. Right, so I'll probably talk for around 15, 20 minutes, and then we'll go on to Q&A and the panel discussion after this. Right. So I'll skip this. I introduced myself already. Essentially, right there, I've been in this industry for around 10 years, built startups before, also led ecosystem strategy, and became a chief innovation officer for one of the largest private university groups here. And I mentioned what I'm into currently. Right? This is very important, right? Globally, there's never ending industry disruption. Since 2000s, right, 52% of Fortune 500 companies have gone bankrupt, have been acquired, or ceased to exist. Right? We know a lot of examples here, and through Harvard Business Review, right, they were saying that 75% of S&P companies will be replaced by 2027. So what we've seen, right, is that companies listed on the S&P 500, this is sort of like a list of the top companies in the world, right? Usually before had an average lifespan of around 61 years. Currently, because of the fast-paced digital disruption that's been happening in the past few decades, right, the current average age of an S&P listed company is 22 years, right? It does not matter if you're a big company, smaller one, right? No one is exempt from disruption, right? The longevity of corporations are becoming less and less because the innovation and the speed of innovation that we've seen, right? From McKinsey, during the financial crisis back in 2008, we've seen companies who invested in innovation, right, outperform their peers by 10% compared to companies who did not, right, who were saying that, okay, we're going to survive the 2008 financial crisis, right? But those who were not complacent, who understood the value of innovation, they put a lot of money in innovation, whether it's through increasing their digital infrastructure, building new businesses, etc., or the equivalent of innovation, right? They outperform their peers by 20%. More so after the crisis, they outperform their peers by 30%, right? So the compounding effects of innovation to those who invested in it early during the crisis, which can be akin to the current crisis we are just coming out of, which is the COVID-19 crisis. A lot of companies, digital transformation was accelerated, right, by at least a decade. And a lot of startups, right, wanting to disrupt the space, who leveraged on tech, are those companies who are reaping the benefits now, right? We have companies right now, for example, like Kumu locally, right? Obviously, they were able to reap the benefits of the pandemic. They accelerated their startup during the pandemic, right? So the conclusion here is whoever is in a crisis, which we are in now, right, prioritizing innovation today is the key to capturing post-crisis growth, which is an era we're entering, right, currently. And with 2026, right, business leaders think that half of their revenues will come from products, services, or businesses, right? Businesses that have not been created yet, right? Because we know this, right? Disruption doesn't really just happen because of new products and services when your business model expired. There are a lot of examples here. And we've seen that one factor that sets winners apart is their ability to build and invest in new businesses repeatedly, right? According to research, 6 of the world's 10 largest companies in the world can be called serial business builders, having launched at least 5 new businesses during the past 20 years, and two of them have actually, 10x their size, right? In terms of building new businesses, right? So these are big companies who consistently build and invest in new companies, right? So this is why we think in Embiggen, right, that ambidextrous leadership is an essential discipline that lets incumbents counter disruptive challenges and sustain organic growth, right? And this is what we mean by ambidextrous leadership. Essentially, when you're an ambidextrous leader, you're balancing two portfolios. The first portfolio is your core business, right? What you've been building, what you've been selling for the past probably 10, 20 years, if you're an incumbent or if a company that's very, very big already. But at the same time, you're also a CEO or a leader, a board member who knows the value of a new business portfolio, whether this is something you've created from scratch internally or you've invested through corporate venture capital, right? The point of this slide is for us to be able to weather the storms of disruption, we need to be able to do these two portfolios simultaneously, core business and new business, right? These are, we think, the three horizons of corporate innovation become really, really important, right? So let's discuss this uh, for a bit, right? Horizon one is really optimizing the core business. And later I'll show you examples of how corporations and leaders are optimizing the core business, right? Horizon two of innovation, right, is nurturing adjacent, no, not necessarily your core business. For example, if you're an insurance company, an adjacent business can be financial services, right? Can be fintech, right? That's an emerging business in perhaps not too far from your core business. That is second horizon of innovation. The third horizon is creating truly new and transformational businesses. These are new businesses or new investments that are not part of your core business, right? So previously, for example, if you are, again, perhaps an insurance company, you're building an e-commerce platform that is a transformational business, right? That's horizon three, because that is not at all your core business, right? And it's these three horizons, right, that we see leaders really trying to find the next core business, trying to look at core growth, trying to look at emerging growth, right? And this is where the previous slide on ambidextrous leadership really comes into play. Those CEOs who are progressive, forward thinking, and who's really understanding the value of innovation or corporate venturing. This is where they come in, right? They do both, or they do all three horizons at the same time, right? They look at optimizing the core business, they're looking at nurturing adjacent businesses through investments or building their own ventures, new ventures, right? And horizon three, creating truly new and transformational businesses. A perfect example of this is Amazon, right? Amazon, they started out as a book e-commerce platform. You can buy books online, right? That was essentially their core business. They did Horizon 2 innovation, which is nurturing adjacent or extending their current value proposition by creating Kindle, right? So you can read the book, but it's digital, right? It's not necessarily the core business, but still related to books, right? And Amazon also did Horizon 3 or doing Horizon 3. And they're doing this all at the same time by creating AWS or Amazon Web Services, right? Amazon Web Service, they didn't have previous experience in cloud computing, right? But they still launched it. It was a startup before. Now it's responsible for around 1/3 of Amazon Group's revenues, right? So the leadership of Amazon does all three at the same time. They optimize their core business, they nurture adjacent and emerging businesses, and they create truly new and transformational businesses that is not part of their core business, right? So this is the types, right? These are the certain ways corporations innovate in general. Yeah? So Horizon 1, again, is optimizing core business. What they usually do is up here, right? This is internal transformation. We're talking about how do you make our processes more efficient through digital transformation. We want to upskill all our people in terms of culture and capability building, right? And we measure this in terms of strategic alignment, the cost, cultural impact, and risk, right? Obviously, Horizon 1, the risk is very low. Strategic alignment, not so much, right? In terms of growth, creating new revenue levers, right? Now, a lot of CEOs are now thinking Horizon 2, right? Like open innovation platforms, right? Which means collaborating with startups. Risk is very low. Strategic alignment is medium, right? Cost is medium, right? The open innovation, you see this. You see corporations doing hackathons, sponsoring hackathons, and probably giving some resources to these particular startups, right? Horizon 2, which is actually the favorite, right, of most corporations now in terms of innovation, is acquiring businesses through M&A or mergers and acquisitions, right? Costs very high, cultural impact is very low. It doesn't necessarily bring a lot of cultural transformation internally because it might be a JV or a complete acquisition, etc. Right? But usually this is where corporations play, right? They do internal transformation, they do open innovation and M&A, right? Only a few corporations go to option 4 and 5, which is corporate venture capital, right? Which is investing in startups to access innovation opportunities and to create sustaining innovation, right? Only a few in the Philippines, for example, only the conglomerates have corporate venture capital, right? And fewer of those people who do CVC do CVB, which is corporate venture building, right? Which is essentially building startups from scratch internally, leveraging on companies' capabilities, assets to unlock new markets and create transformational innovation, right? Strategic alignment is very high for CVB, obviously, because it's very organic, right? So whatever the corporate strategy is, building new business from that corporate strategy, right, is very aligned, right? The culture impact, medium, right? Cost is very high, but in terms of the impact, right, to revenue, it's also very high. The same with CVC or corporate venture capital, right? Most innovation strategies of corporations, if I want to be a more innovative company, I want to access startups who have more innovative mindsets, who are very entrepreneurial, who have very proprietary technology, they move fast, versus a large corporate who don't do that, right? So these two um, uh, options, right? Corporate venture capital and corporate venture building collectively is known as corporate venturing, right? So these two have the highest return of investment in terms of innovation, right? And perhaps we'll talk more about this during the Q&A. But essentially, these are the things that corporations do or can do, but only the top three are being done really heavily. And I think in terms of this, at least in this keynote, we might want to think, right? What is the effect of corporate venture capital or corporate venture building in our corporate strategy, especially in our innovation strategy, right? So this is where you need to focus on, right? CVC and CVB. And we think this is sort of the next era of corporate innovation, right? However, the problem is that for most of these platforms that we've seen, the 5 previously in the slide, right? Most innovation leaders know it's the most important way to protect market share. However, 95% of them fail, right? And the reason for that's because internally they don't have the mindset, right? For people, right? They lack the manpower to be able to think big, act fast, iterate with intelligence, and optimize for learning, right? This is where we say traditional management and innovation management should not be mixed because there are very different metrics for innovation. And if you apply traditional management to innovation management, it doesn't always yield the best results, right? We've done this, we've seen this through experience, right? We also usually corporations fail in terms of skill set, right? They don't have experience, for example, investing in startups. They don't know what to look for. Also building startups, right? So we need experienced and dedicated stage relevant teams. So at each stage of whether it's CVC or CVB, who knows how to execute that particular phase, right? And third, of course, is execution. How can you do it quickly, quietly, and capital efficiently? Right? Mostly in incumbents or big companies, there are different layers of management that really reduces the speed at which we do innovation. Right? So these are the 3 reasons why corporate innovation fails usually. Right? So this is where we usually help. No? So for large companies, the key to success is really combining the strengths of an incumbent, which is a big company, with the agility of a startup, right? Which is an interesting mix, right? So in Embiggen, right, and of course some of the people in the panel as well, right? We become the co-founders of your corporate innovation strategy. Our value add, right? We're seasoned tech entrepreneurs. We've built startups from scratch before, venture funded. We have experience in idea to scale operations. Obviously, the mindset of a startup, the entrepreneurial mindset, is there. Which I think the fourth one, which is very important, which is the innovation methodology process. A lot of corporate innovation leaders spend a lot of money in an unvalidated idea, right? Or an unvalidated process in terms of investing in startups or building new startups, right? In our methodology, which I will show in the next slides, right? We significantly de-risk the ventures through what we call MVP, or the minimum viable testing. We test the market without even writing a single line of code, right? And for corporate venture capital, most corporations have a hard time in terms of deal flow. And Embiggen and our partners, we have international deal flow in the most more mature digital ecosystems in the world: Singapore, Israel, for example, Germany, right? Silicon Valley, right? And of course, our corporate partner, which have become our co-founders, right, have very deep market and industry experience, assets and resources, IP, capital days, your investment, of course, a network and ecosystem, right? So the co-founding partnership in our engagements, right? Essentially, we create a co-created innovation portfolio of new ventures built or invested in, right? We saw down here, no, this is a bit the fine print, but we've seen that corporate startups or corporate ventures, right, have 1/8 probability of success versus typical startups, right, who don't have, who wasn't born from a mother company, that it's a bigger company, usually have a 1:500 probability of success. So in terms of de-risking the investment, corporate venturing is the way to go. Right? So we're incorporated in the US. We do corporate venturing. We help corporations build startups from scratch, and we also help them set up their corporate venture capital arms. Right? So essentially, we want to help corporations achieve innovation-led growth through venture building and venture investing. Right? So mostly, we've seen in corporate innovation leaders, right, that it's really a lot theoretical, but what we want to do is to get them from thinking to doing and building actually startups from 0 to 1, right? We're 100% focused on execution versus just strategy, right? We're not consultants or venture builders, and we build technology businesses. Right? Founding team, myself, I've showed you my experience, but with Earl, who's also founding partner of Embiggen, a graduate from Stanford, Cornell, previously corporate innovation leadership in Bridgewater, Smart, Charles Schwab in the US, and also founded his own fintech startup. Paul Pajo, who you will meet later, founding partner of Embiggen. Also in the innovation team of Smart, who co-ideated and co-built Idea Space, and also currently the head of innovation for Hi-Fi, or the incubator of College of St. Benilde. Another founding partner is Pham, who also graduated from Stanford, former head of innovation for one of the biggest insurance companies in the world, one of the youngest VCs in Silicon Valley after graduating from Stanford. So this unique mix, right, of corporate innovation leadership, right, not just corporate innovation, but also startup leadership, right, is what usually our clients appreciate, because we don't just do startups, we also do corporate innovation, right? So this unique mix of the founding team is very important for execution, mindset, and skill set, right? So this is sort of our methodology, right? The companies, right, that we've worked with, both locally and internationally, right? And in terms of building new ventures, we usually have what we call stage gates to de-risk the innovation portfolio. At each gate, from phase 1 to phase 2, from discover, for example, trying to discover what the market really needs. Before we design, we have very clear criteria, right, of what ideas really go through the next phase. Right, phase 2 is obviously design. Now we build, we design the ventures, design businesses, right? We do assumption mapping. In phase 3 now, we do minimum viable testing and we build a minimum viable product, which are two very different things before we accelerate the venture, right? So in terms of corporate venture building, this is the way we do it. Um, so why do corporate venture building? Why sort of build startups from scratch internally, right? We want to be able to build new growth engines fast and capital efficiently, right? Increase absorptive capacity, which means that you have more interaction with the market. The higher you go in the corporate ladder, you don't know what's happening on the ground. Obviously, you want to defend from disruption. You also want to retain star talent and develop entrepreneurs, which is totally different conversation. But what we've seen is that star talent tend to leave organizations who are not innovative, right? And we want to build an innovation culture, right? So this is in terms of building new startups, right? So what do we do in terms of capital, right? So how do we set up corporate venture capital? And we'll talk about this later more in the Q&A. But essentially, one of the reasons why you want to build your own fund, right, is because if you invest in a current fund, right, if you're a company, right, if chief financial officer, chief investment officer, right, or a CEO listening to this, you want to stay in control. We manage the fund, but you stay in control. This sort of the process from investment strategy to deal flow to due diligence to even portfolio management and integration and exit, right? We help you every step of the way, outsourcing the administrative and strategy parts to us, right? But why do you want to do this, right? So number one is you want to control your own investment strategy versus investing in a venture fund, which essentially is you're investing in a current fund strategy. So you're trying to give money to a fund strategy that isn't yours. Right? And there's a lot of advantages to this. There's also a lot of cons because you want to, secondly, align with corporate strategy and your current business ecosystem, right? So if you're a conglomerate, if you're a group or group of companies, or an emerging conglomerate, right? This becomes really important because um, how do you want to build your ecosystem? Which ecosystem players currently in your group can your fund leverage on or your portfolio leverage on, right? Which is something that's absent if you just invest as a limited partner in a fund. Thirdly, higher investment returns, obviously, because you don't need right to pay the 2% management fee and the 20% carry of the venture fund. That's all yours. Of course, the operational expenses you can manage. Right? And of course, lastly, direct portfolio management that aligns interests of the startups and the core business. Right? You have more interface to help these particular startups to help them grow, right? Versus investing in a current portfolio of funds, right? So this is also very important for startups, right? If a company has their own venture capital fund, you want to be able to align with that strategy, right? So one of the biggest retailers in the country right now, we're helping set up the corporate venturing strategy, which includes a lot of sports tech investment strategy, a lot of retail, a lot of logistics, which they already have the experience in running, and they're looking for specific solutions from the startup ecosystem to be able to do that, right? Which is something that might be absent when you just get, for example, venture funding from a venture firm, right? Not from a venture capital, a corporate venture capital fund, which already has the deep expertise and experience that you can actually leverage on to build growth for your startup, right? Essentially, these are just examples of startups that were invested on or built internally. For example, Shell built MachineMax. MachineMax provides an equipment management platform for off-road equipment users, right, to maximize productivity and profitability. Shell obviously is not in the business of heavy machinery nor digital logistics or IoT, right? But they built this, they invested in it, right? They're in oil and gas. The same with SGN, one of the biggest oil and gas companies in the UK. They built Field, which is a digital platform designed to transform the safety and efficiency of field teams. Right. So these are corporate ventures, right, that came out or invested on by big companies. The same is true by OpenSC. Right. OpenSC is a spin-off from WWF. Even NGOs are doing this. This is a core offering the technology trying to verify if you really have the claims for low carbon, right? Responsible production in an automated way, right? Locally, we have Frutas, who is now venturing into cloud kitchens, right? So these are just some of the ventures that we've been building, right? Also investing in. So one of the oldest local insurance companies in the Philippines, venturing an innovative, first of its kind platform for millennials and Gen Zs. Right? They're not. This is not an insurance product, right? But they built a tech product that we invested in. Right? We built the investment strategy, the scorecard, etc., and we're actually building startups with them as well. A big local food manufacturing company wants to solve the logistics problem in the Philippines. There are a lot of players here, but no one yet has unlocked the solving the problem for logistics in the Philippines. Also, a big provincial diversified holding company wanting to solve the micromobility problem and capture the micromobility opportunity in the provinces. And of course, one of the things I mentioned earlier, we're setting up a corporate venturing strategy for one of the biggest retailers in the country. Right? So these are just select examples of corporate venturing of bigger companies doing H1, H2, H3 innovation, investing and building their own startups, right? Because they know that they're not immune from disruption. And corporate venture building and corporate venture capital is perhaps arguably the fastest way to do corporate innovation, right? So thank you very much. And let's all build meaningful growth together. Thank you.
All right. Thank you for that, Roland. So again, earlier Roland just mentioned his keynote speech for on behalf of the Embiggen Group, and my name is Marian Camacho. I am the head of business development at the Embiggen Group, and I'll be your moderator for this panel discussion. Joining us at this panel is first Paul Pao, the OIC Director, Incubation Management Head, and acting TBI Manager of the Hub of Innovation for Inclusion, or HiFi, the Technology Business Incubator of the College of St. Benilde. He is also a limited partner of Backend Capital, behind Genius Ventures, board member at Dentina, and a founding partner here at Embiggen Group. So, hello, Paul. Are you there?
Hello, hello. Hi, thanks for the intro, Marion.
All right. Thank you, Paul. And then also joining us this day is RJ Angeles. He is the co-founder and Philippines country manager for Bayfront Capital Advisors. He is also the president of From Art Tower Corporation. I hope I pronounced that right, RJ. President of RSA Superior Distribution, president of RSA Prosperity Microlending, and vice president of business strategy of Agri Logistics Solutions. Hello, RJ.
Thank you, Marion. Yeah.
All right. So this discussion will mostly revolve around the topic that Roland discussed earlier. So we'll touch on corporate venture building and corporate venture capital as our main topic. So with that, let's begin. So Roland, based on your presentation earlier, you talked a lot about corporate venturing. What is it exactly, and how does it amplify corporate innovation? And can you give us some examples of some clients that you worked with that made that aligned with these strategies and made innovation a key priority for their long-term growth and strategy?
Okay, thanks, Marion. Hi, RJ. Hi, Paul. Um, okay, corporate venturing is the strategy for innovation for big corporations to invest and build new ventures, essentially, right? Why is this important, right? I think discussed this comprehensively during the keynote, but what I wanted to reiterate there is that if you want to build new growth and defend yourself from disruption, right, from new digital startups who want to take your place or take your market share, right? What's very important to consider is can I do it fast? How can I do it capital efficiently? And how can I do it that is completely aligned with my corporate strategy or where I want to go in the next 5 to 10 years, right? Which mostly, I think I mentioned, if you're investing in a current fund, if you want, for example, to participate as a venture capitalist, right? If you're investing in a current fund, it's very hard to say that this is my corporate venturing strategy, right? And take my money and only invest in startups in this vertical, right? So you do not have control in terms of what you're investing in, and essentially which particular investments of the portfolio will align with the corporate venturing strategy, right? The same is true for corporate venture building. That's also the reason why they want to build their own startups versus just acquiring startups, because they want to build something that is not yet seen in the market, that they think they're the best people or the best organization to actually build it from scratch. So, but I'm curious to hear RJ and Paul's thoughts about this also.
You gonna go ahead, Paul? Yeah.
Yeah,
Mhm.
I think this is a new idea that connecting the corporate capital to the startup world in a more deliberate manner. So in the Philippines, we've seen that the successful conglomerate startups, for example, PayMaya, which is now Maya Bank, and GCash, which is considered duocorn, right? So those are good examples in the Philippine ecosystem. And I myself, since I am a TBI manager, technology business incubator manager, you can abstract a TBI in a sense like a conglomerate backing, because that means when you are an academic institution, you do have access to the academic institutions resources like the alumni network. If you're a government accredited TBI, you have access to government funding not only for the TBI and the startups, right? And everyone's waiting with bated breath the IRR, the implementing rules and regulations for the startup. But we all know the individual agencies do have their funds, right, that being lined up. So in that sense, this is happening. But like we said, there are certain triggers in the ecosystem that we are waiting for that particular ecosystem, right? But there's really nothing stopping corporations from doing what Metro Pacific is doing, what Ayala is doing, uh, in a way like Kaya Ventures and Day One Capital. You can trace back their origins to conglomerate uh, partners, like the ones who instituted these funds are actually part of the bigger ventures, but in a sense they're doing their own investment thesis. So when you look at that from a big picture, there is a lot more capital that can be unlocked from the other conglomerates. We can probably think of maybe 50 to 100 different conglomerates that they probably asking themselves, what can we do to do the same things as this particular fund. So, for example, we can look at Gentry, right? We know this is from the SM Group, and Gentry has their own very particular thesis. So, are we looking at the innovation front? They're probably asking, okay, if they can do it, what's actually stopping us from uh, doing so, right? So, yeah, I think Roland mentioned that. The conglomerates or the corporates have a choice of creating their own fund or creating their own fund structure or innovation strategy based from all these other permutations that uh, uh, people have gone ahead of them. So I think that's what Embiggen can help them with in terms of structuring or just providing guidance. Many times they do have the resources, these corporations, but maybe they just need help, no, from groups like Embiggen or even Bayfront Capital.
No, no, thank you, Paul, Roland, for that. I think you've already mentioned the key items, no, why these things are needed to continue innovation in companies, no. I think one thing I'd like to add is really geography. So, for example, like the CVC of the JG Summit, JG Dev, they actually put in something in South Africa, right, a couple of years back. So although, for example, some conglomerates and companies are operating in the Philippines and they have laser focus on the geography and the existing product set, no, they sometimes fail to recognize that there are other things happening in the rest of the world. And through venture building and putting up your own VC or CVC allows them access in all of these potential deal flow that they can see globally, which sometimes they feel it can actually redundate their business, right? So to my example earlier, right, you have JG Dev, they had a JG. I mean, they just sold the bank now to BPI, Robinson's Bank, but they were actually looking out for stuff outside, which initially, if you look 5 7 years back, companies in the Philippines would not look at these geographies, right? They'll go through their traditional M&A of acquiring their existing business, or existing
Mm.
products or existing services that they actually give. And Paul mentioned Gentry, right? It's also now investing in all of these ASEAN startups, which in the I would say 3 5 years ago they won't have access to, and that's why it's really important. I mean, Roland already mentioned it. No, I mean, if companies don't continue to innovate, they'll be redundated. Really.
Yeah, thank you for those answers. RJ, since you already talked about M&As,
Yes.
what's the
Mhm.
main difference between
Okay.
investing through venture capital
Right.
and investing or acquiring through mergers and
Yes.
acquisition?
Okay. Sige, thanks for that, Mario. No? I think, in terms of process and flow, it's actually fairly the same, no? You go through a due diligence, you go through all of these goals, but really the intent is different, no? Normally, traditional M&As are really backward looking. They actually look for products who are actually either part of their current product set, their current services set,
Mm.
or their current operations. For example, take for example ICTSI, right? They acquire ports globally, in their existing business. They do have stuff, in China, Madagascar, everything. So it's really more of, I think, reviewing business which are, backward looking. They have history, they have already profitability, and these companies take over, and the geography is attractive to the current
Mm.
a corporate acquirer or the buyer. But in the CVC space, I think the goal and the intent is much more different. It's really more for innovation, change of culture. At the same time, it's more forward looking, because normally these times when you do due diligence for VCs or startups, you actually look more for the market, the TAM, the SAMs, all of this, rather than the history or the profitability of the one being sold. No, so I think those are the main differences in my sense for M&A and the VC or CVC setup. No, but the process I'd say is somewhat different, but the intent and the goal is fairly different. Maybe Roland and Paul also have some views. No.
Yeah, I think in terms of investment strategy, right?
Yeah.
VC is really investing a small amount
Yeah.
in a larger basket of
Cool.
bets,
Right.
which I think de-risks the innovation portfolio of a company. Whether, for example, you're investing in other asset classes, not just probably you're doing M&A, you're also doing VC, but you're also doing like bonds, maybe, I don't know, right? But venture capital really is trying to place smaller bets in a lot,
Mm-hmm.
which I think effectively makes innovation faster, right?
Mm-hmm.
But secondly, the risks
Right.
the investment portfolio overall, right? So yeah, I think
Mm-hmm.
yeah. But Paul, RJ Paul, you will know more
Yeah.
more about this.
Yeah,
Actually,
so
Roland, to your point, just to add to my, I think discussion earlier, I think really M&A is really more for current product set. No, it's not really for
Mm,
them to sort of really look for, something which is, really beyond their scope. No, and that's really where the VC, the VCAS setup really helps them, because they see all of this deal flow. Na, sometimes they say, okay, this is actually relevant for us. So it's really de-risking their current portfolio, because sometimes they're just so focused on really their core business that sometimes they forget that,
mm,
there's activities outside in the world that can actually complement or not even totally, not related to your current portfolio, which may be of interest to the current acquirer or to the current conglomerate. No?
yeah, and to RJ's point, when you look at the de-risking part, right? You look at the conglomerate wherein their investment thesis is very specific
Yes.
to their conglomerates, or the what you call it, the tangential or the adjacent industries,
Yep.
right? And
mm,
then you have, let's say, just for the sake of
Hmm.
the argument or conversation, let's say you look at Gentry and
Yes.
let's say Day One,
Yeah.
Kaya Ventures, and then you look at that, and the ones who are behind those funds are, you could tell, you could know, you look at who's actually behind that. They are related to conglomerates, but basically
Mhm.
they want to invest in the startups, and they're using that structure in a way like it's like an
Mhm.
angel
Yes.
investment structure, but they're like a super angel because
Mhm.
angels normally don't have the machinery of the conglomerates to help you.
Yes.
So in a way, these funds can introduce you
Mhm.
to that conglomerate structure, but it's not directly connected to the structure, right? And then you have someone like Foxmont, right?
Yes.
And they are the first
Mhm.
pure non-conglomerate fund. In other
Mhm.
words, they really don't have a quote unquote conglomerate agenda to
Mhm.
speak with. But when you look at the investors also, the people there are part also of conglomerates, but they're
Yes.
Mhm.
doing in a individual manner. When you look at
Capacity.
that,
That's right.
if you do a gap analysis of that,
Mm.
uh, the elephant in the room is what happens to the conglomerates actually who actually want to do
Mhm.
what Metro Pacific is doing, what the
Mhm.
Ayalas are doing
You're
via,
doing.
let's say, Kickstart, or
Yeah.
what maybe Sterling is doing, right?
Yes.
So I think that's the missing part. So
That's the gap. Yeah.
Roland and I have these conversations, right? Because our a good friend Jojo
Mhm.
Flores from Plug and Play,
Mhm.
whenever they're invited, he's invited to like events like Kulitan.
Mhm.
That's one of the things he points out. He said these other different fund structures have a different
Mhm.
nuances of how they want to address the conglomerate agenda, but no one's really helping the conglomerates
Right. Mhm.
connect to their own internal corporate innovation
Yes.
agenda. And when you think
Mhm.
about it, uh, as a group, right? If you take this
Mhm.
group as an aggregate, they probably represent billions of dollars in capital
Yes.
in the
And
Philippines,
undeployed capital,
Mhm.
right?
undeployed capital.
Yeah.
And if you think of it in terms of timing, uh,
Mhm.
if you think of how much capital they could have deployed, let's say in
Right.
2020, 2021,
Mhm.
2022, that represents a lot of dry powder that they're just waiting to deploy, especially now that they now see, okay, so there are
Mhm.
these structures, right, that we can look
Yes.
into, but who can help us? Who can actually help us
Set it
do,
up.
like an idea space play, like a
Mhm.
Kickstart Ventures play, like so there is a gap. If you do a gap analysis in the market, that
Right.
represents a very good opportunity for uh,
Mhm.
companies like Embiggen Group
Mhm.
who might want to
Mhm.
take as a wonderful opportunity.
That's right.
Yeah. Thank you for those comments, guys. I think one more question, and I'd like to
Mhm.
open this to everyone. Roland, in your presentation earlier, you mentioned that sometimes it's better to set up your own fund rather than
Mhm.
becoming an LP to an existing
Mhm.
fund. Can
Yeah.
you expound that more? And then, of course, asking for RJ and Paul's,
Yeah.
inputs on this as well.
Yeah. Okay. So most startups know, right, that the way VC funds work, there is a general partner which leads the fund in terms of investment strategy and actually
Yeah.
does the investments, and there are LPs who are limited partners who
Mhm.
invest in the fund,
Mhm.
right? But they don't lead the fund,
Yeah.
right? So that's okay to start, right? But if you're a company who has very clear investment strategies or a very corporate agenda, right? Who this is where we want to grow, this is how we want to grow. It's better to sort of set up your own fund. Um,
Mhm.
also join. It doesn't preclude you from joining as an LP, right? But you
Yeah.
also
Yeah.
want some form of control
Mhm.
to where you're going to invest, how you're going to invest, how much, and all of the investment strategies, and decide right where to invest and not to invest. Right. So essentially, that's one of the things that most
Mhm.
CVCs value, which is independence and autonomy. Right.
Right.
So yeah, RJ Paul.
I think I'd just like to echo what Roland was saying. No, it's really control. No, particularly on the investment strategy, right? I mean, sometimes, for example, if you would like to really, be clear to align your goals for your corporate innovation with, your investment strategy, it would be easier or either straightforward or tailor fit to do it through a CVC or a VCAS setup rather than, entering as an LP in a current VC, no? I think, the other thing you have to be cognizant here also is sometimes, investment decisions sometimes are half or, majority because it's a VC, right? There's a partnership, there's always a discussion. But I think if this is your own fund and your own VC, then the decision making is also more agile, I would say, it will be sort of, if it's aligned with your goals, then you can definitely already make a decision to already invest in the startup rather than going through the notion of, trying to get all the partners in array to actually agree to invest in whatever target you're looking for.
Yeah, to echo RJ's sentiment. One way you can look at this is like obviously if this is new to you, you're, let's say, part of the conglomerate, and you're a decision maker, you're an upper management. What's good is you need to understand like the opportunities inside the
Right.
space, right? So for example, Y Combinator recently announced that for whatever allocation they still have, some of the startups are actually making available the investments to
Mm-hmm.
like FINRA regulated
Mm-hmm.
uh, sites like WeFunder, Republic. That means even if you're a non-accredited investor, you can put $100 and consider yourselves
Mm-hmm.
angel investor. I'm saying this because
Mm-hmm.
uh, for some of them, they might not understand some of these new structures. Like
Yes.
in the US,
Right.
there's probably 8% of
Mm-hmm.
Americans are considered accredited investors, but they don't know it. So they can just invest
Mm-hmm.
in any of this fund immediately, right? But
Right.
they
Right.
haven't really checked. I'm
Yes.
making $200,000 a year. Maybe they're a
Yep.
doctor, lawyer, and they can invest
Mm.
even not through WeFunder or Republic. They
Yeah.
can directly become an LP to these funds.
Yes.
But again, I always tell my people I advise with. Risk is a function of knowledge, right?
That's true.
The
Very true,
less
Paul.
knowledge you have, the more risky it is, right? So
Yeah.
maybe you go to Republic and then you put in maybe $100 to $1,000. So for example,
Mm-hmm.
um, what's this name? Gumroad raised $5 million in 10 hours, but they
Mm-hmm.
put a cap. They said
Mm-hmm.
you can only put maximum $1,000. And true enough, when you look at the
Mm-hmm.
SPV, if you look at the SPV as a cap table, the average was $670 per investor. So it's even less than 1,000. So I'm
Yeah.
thinking, if you're in a corporate and you want to understand, right? You just want to
Mm-hmm.
say, are there even startups that are aligned with my investment thesis? And you go there through FINRA regulated Republic. Then you
Mm-hmm.
find out, okay, this is good. I can probably structure a fund, right? So you go to maybe a syndicate in AngelList or RUV. So what's happening there is you're going up your risk appetite, and before you know it, you're an LP into a fund. But I've seen
Yeah.
this happen, right? A new fund,
Mm-hmm.
they'll say, "Hey, Paul, this is a new fund. You can come in at 50 to hundred thousand
Mm-hmm.
dollars." But what happened is, if that fund is like Fund One, right? If it's really really good, uh,
Mm-hmm.
if you're not careful, what happens is 2 3 months into the email, you'll
Mm-hmm.
just see like, Paul. I've seen this with my own. I said, Paul, now our minimum is $500,000. What happened? So they moved
That's
from
right.
50K.
You
So
don't
what
have the
happened?
dry powder already. Yeah.
Yeah, because so sometimes that's the point, right? You go to Twitter, there's a lot that we want to go into venture. The
Yep.
thing is, there is an opportunity to go to
Mm-hmm.
venture, like these structures, but the opportunity window is very small because these things move very,
Mm.
very, very fast. So in a way,
Fast.
also, if you're in a corporate setting, sometimes what in the world happened there? Like
Mm-hmm.
first the minimum was 50K, and now the minimum is
500.
500K, and the fund one is closed, and now they deploy capital. I've seen like, okay, I've seen investment in 2 years. They're
Mm-hmm.
close to fund one and they're raising fund two. So
Mm-hmm.
so I think this is where these structures come from, because in a way, when you look at the timing for the corporations, in the in the
Mhm.
VC world, the speeds are misaligned, right?
Yeah.
Mhm.
By the time someone decided,
It's
the
already
fund
done.
that they're considering is probably closed, and the ticket size is maybe
Mhm.
they got approved for
Bigger.
$100,000.
Mhm, mhm.
Now it's bigger, right?
Yeah.
So that's the other thing that maybe Embiggen and Bayfront,
Mhm.
can help in the structuring, right? Because
Yeah.
maybe you wanna align
Yep.
the speeds of how this is that. Eventually, what will happen is the corporations ideally will have a way to be able to capitalize on these opportunities, and they
Mhm.
in a way reverse engineer the structure, so they be able to write the check fairly
Right.
quickly, right? And get all
Mhm.
the approvals very fast. But we all know if you've done that, that has to be a very deliberate attempt for them to actually do that. And they need to understand that this is a very good opportunity for them. But until that time, that's where the opportunity is to
Mhm.
align the speeds in this kind of
Mhm.
opportunities.
Okay. I think since we all spoke about the fund size, I'd like to ask you, RG and Paul,
Mhm.
what's a good fund size to start with? If you wanted to try and dip your foot and fingers in venture capital investing.
Uh, well, it really varies, no? Sorry, yeah. In terms of size, no. But I guess right now to make it more, I would say, beneficial for maybe for a conglomerate or an emerging conglomerate to at least make it, worthwhile. I'd say it's around 500,000 US to start with. That's a good size for them to look at, seed stage investment in different companies, regionally, and then maybe up to $1 million. I'd say that's a good size for them to start with.
Yes, I agree. Like the other way is you look
Mhm.
at the model where
Mhm.
you even at $1 million or
Yeah.
$500,000, your fund acts like a trigger
Right.
investment
Yeah.
for other funds. So the way this
Yep.
works is I say this is a joke, right? I mean, the way a
Mhm.
VC says no to you is that, yeah, we'll invest in you if you find a lead.
Usually, Paul,
So
that's what happens, no? You
yeah,
find the lead first,
so
and then they'll
so
follow,
like
right?
and then the poor startups like they're trying to find a lead, right? And
Yes.
uh, so if the fund is really or this new fund that can act as a trigger and local
Mhm.
trigger investment, because I've seen this in the Philippines wherein the regional funds
Mhm.
say, Paul, we're ready to invest in this startup, but
Mhm.
we need to give something to our LPs, right? We need to tell
Mhm.
them we're investing, but they're gonna ask us, is there anyone local who's investing? So someone uh, like ID was talking about, a regional and all the investment thesis, right? So you might have a fund, let's say from Singapore or Malaysia, or let's say a global VC with a regional investment thesis, but before they even write their check, they're gonna look for someone who leads. So that's one way to think about it. So I remember Timos Capital in Singapore. They were like less than a million, but what
Mhm.
happened was the Singapore government basically said, if we will match every dollar that you invest 10x. So it's weird, right? Because they're like less than $1 million, but they actually deployed, when you think about it, like 11x the capital, because they every time they invest, right, the Singapore government will actually match that fund. So in the VC world, that can happen also, right? You might I've seen this happen for example, coins that PH, right?
Mhm.
Idea Space actually in a way started as a local trigger investment, because I know, because I brokered that deal, right? So when Idea Space invested that small amount compared to the other funds, but it allowed all the regional funds to say, hey, there is a local trigger
Mhm.
investment. They did due diligence
Mm.
with this startup, and then of course the rest is history, right? Coins exited at
Mhm.
$72 million. So we're not talking about theoretical discussions here. Like that, you can lever that 500,000 to a
Mhm.
$1 million fund to do amazing things. At the same thing, if you really did your homework, that means your fund one would be probably a very very
Mhm.
successful fund, and that's normally the what they call this. This is the baseline, right? You
Yeah.
need to have a very successful fund one, So if you can have a successful fund one at $1 million, that means when you raise fund two, all the other LPs are going to start running to you. But when you look at it, you're actually acting as a sort of a de facto lead investor for everyone else who's looking for deal flow. So yeah, 500 to a million uh,
Mhm.
dollars should work at least if you're experimenting,
Yeah.
for a fund one.
Okay, thank you for that, RJ and Paul. And I
Mhm.
think another question I'd like to squeeze in is, given all of these things, people can actually do it on their own.
Mhm.
However, I'd also like to ask, why should I work with an external partner in
Mhm.
building and managing a fund? And for example, with Embiggen, and if I do work with an external partner, what's going to be my involvement?
Mhm.
I guess we can start with RJ.
Yeah. No, I think it's just also like, eating and cooking, right? I mean, you can cook at home or you can do your own food, right? But if you want to have a better dining experience, a better, menu, you have to get external people to do it, right? Same in the case of, VC setup and investments because the process is also quite complex, no? You have to work with the right guys with experience, with network, and who does the right diligence for you and your corporate setup. So the more important thing here is also deal flow, right? You really have to make sure that
Mm.
the people that you work with are the guys who will continue to, give you deals on a regular basis because that's really the purpose of setting up the VCAS. So I guess to my comparison earlier, right? It's just also like cooking at home versus eating in a restaurant. It's really better to work with external parties like Embiggen to do these types of activities in order for you to make sure that you align your investment strategy, your thesis with MBGN, and as Roland had pointed out, for these things you stay in control, but the process will be led by a team of professionals. You'll be updated regularly. And in effect, if you want to change stuff throughout the process, obviously there's flexibility and agility on the MBGN side to do it.
I
Yeah,
just wanted to echo
Yeah.
RJ. It's very hard to get good deals, no?
Yeah.
Especially in the venture capital industry, right?
Hmm.
Average is 1 out of 10 will succeed, right?
Hmm.
So nine will fail. But you want to hedge your bets, right? So how do you increase the likelihood that your investments are going to bear fruit?
Hmm.
Right? And usually starts and ends with deal flow, right? What are the types of deals you get, right? Who are your co-investors? How big is the fund, the dilution strategy, etc. Right? So these are stuff normally corporations don't have experience in,
Yeah.
and VC people, right, have their own funds, right?
Hmm.
And the VC analysts, etc., they join these funds. They don't join usually corporate funds, right, which are usually heavily on
Hmm.
M&A, right?
Right.
So in terms of talent, in terms of skill set, mindset, execution, right, it's really with an external partner. You'd also have a very objective set of eyes, right? Where do I invest in? Where do I not invest in? What do you think of this, etc. Right? So all of these things, I think what RJ already said, but I think for me very important would be deal flow. Right? So Paul.
Yeah, so this will learn from Kylie ng 500 startups before. He
Startups.
said,
Yeah.
I said, why should you invest in our fund, right? So first thing is deal flow. You need to know where the deal flow is. But let's say you get the deal flow. The next thing is you need to have a group of experts in your network to
Mhm.
vet if that startup
Mm,
actually even makes sense. So remember, a startup is not like your normal
Mhm.
Starbucks. Um,
Yeah.
a lot of the ideas there, it's
yeah.
the first time you see in the universe. So
Mhm.
and most of the time the ones starting the fund they have no expertise in this. So the
Mhm.
the role of Embiggen and Bayfront and all this is they do have access to this other network that can say that maybe this startup's idea has a 1% chance of even making it, but it has to make sense, right? This is the second one. The third one is the ability to deploy the capital, right? Because
Mhm.
a lot
Mm-hmm.
of these things is opportunistic, right? Once the startup already raised money, then your fund, your VC, whatever fund structure is, becomes irrelevant, right? And the other one is like the practicalities. No, Roland mentioned that the talent,
Yeah.
the talent skills for that. But the other one
Mhm.
is a lot of times when you want to do this on a corporate level. Like for example, I had a deal before where we were talking to someone, said, Paul, we do want you to do this deal, but we want to turn this into like an equity play. So we had to invent a new structure called a
Mhm.
GTM, go to market convertible note. Now,
Mhm.
so the we issued the note, but then we realized like on the back end, we actually have to create a lot of the
Mhm.
structure on
Mm.
the corporate back end. But if that's an opportunistic deal, the question is how fast can you actually
Yeah.
execute that? We know corporates, you probably have like a corporate, someone in corporate upper management who's shepherding this deal, right? Because they
Mhm.
wanna have something on management reporting for the quarter for this year, uh, for them to get promoted. But if you miss that cycle, so we all know this, right? The corporates, they do a reorg every
Yeah.
6 to 12 months. Once you lose that upper management sponsorship, that means nothing gets done, right? So in other
Yeah.
words, you need to have that speed of execution, not
Mhm.
only on the fund level, right? But you have to align on how fast the corporates will change. So if you
Yep.
understand that externality and practicality, that means you probably need someone who already knows how to do this quickly, because you need a lot of time and effort, as Roland mentioned, not only the talent but just all the logistics, right? To
Yep.
even do this. There are groups that are very good with this, right?
Mhm.
And we all know this, who are the conglomerates who do this. But
Mhm.
outside of those top 3 or 4 conglomerates who are already well known to execute this, that means the other conglomerates actually are not doing it. So therefore, they need help in terms of the logistical execution. So they probably need a third party just
Third
to help
party.
help do this.
Okay, thank you for your insights, guys. And then I think we have time for one more question. So we mostly spoke about venture capital investing or venture capital, which is investing in startups. On the flip side, are the people building these startups, building solutions for problems that they see and that the market needs. So if I was a corporation, why should I build startups when my existing business model is just working fine, it's generating profits? Why should I consider building startups? Roland, let's start with you.
Yeah, I think I mentioned earlier in the keynote, right? Disruption really doesn't happen when not just because of products and services, but because business models expire, right? And it is going to expire, right? 10 years from now, the current disruptors are going to be disrupted. Probably, we don't know in the fintech space right now. The hottest thing is, fintech wallets, neobanks, right? What's the next business model, right? We don't know, right? So in terms of trying to get ahead, trying to make sure that you're ahead and staying there are three different things, right? So this is why I think corporate venturing is a very important topic to talk about in terms of corporate innovation. Of course, if there's already something out there, for example, you want to build, I don't know, you're perhaps a hospital, you want to do biorobotics, right, exoskeletons, etc. There's a company already doing that, and you like the business, right? You can invest in them, right? But if there's no one doing that, then you build your own, right? If you think that in terms of innovation, this is where the next frontier is going the next 5 years, and that there's nothing existent in the market, or you see an opportunity, no one is actually solving it, or no one's solving it the right way you think is the correct one, then you build it, right? I don't think internal transformation is enough to do, to protect market share. I don't think, just doing open innovation programs is enough, although it's good. No? Again, it's not to preclude doing those other four or other three corporate innovation vehicles. But what we're saying is that if there are things that you can think of, right, in terms of opportunities, in terms of millennials and Gen Zs, for example, wanting to capture that market, and no one is actually doing that, you cannot invest in startups in the world, right? Just invest in yourself and hedge your bets, right? In terms of building your own startups, as I mentioned earlier, the clear winners in corporate innovation are serial business builders, right? The biggest companies in the world are companies who do not stop building, acquiring, investing in businesses, right? And I think in terms of corporate innovation, corporate venture capital and corporate venture building is the fastest way, perhaps the next era of corporate innovation versus just doing R&D, right? Because innovation is really how do you capture the value, not just to invent something new, but to make sure there is business value and there's social value to what you're doing, right? So all those things combined, I think corporate venturing is really the next era for corporate innovation. So yeah, thank you, Marlon.
Great, thank you, Roland. Paul, would you like to add on
Like
that?
Roland mentioned, protecting market share, but I think what the pandemic clearly emphasized and maybe etched into the minds of every C-level executive is maybe that market share won't even exist, right? So you
Mm,
need, and that's the reality. Like a lot of this innovation proposals or projects normally before the pandemic, they said, "Oh, we're gonna do this in 3 to 4 years," and um, you can nicely say that some of these are innovation theater, so to speak. And then pandemic happened, and then they realized their market share got obliterated overnight. So their main rationale for existence actually uh, is gone, right? So there's even no
mm,
future proof, so to speak, right? So for those listening here, so maybe as a C level, your CEO, COO, you now have uh, what they call this a very big cognitive load or burden in your mind now. How do you even go through this kind of uh, how the extinction level event, so to speak, at a corporate level? So look at you can look at these interventions
Yes.
as an existential hedge. That's the so forget about future proofing if your
Yeah.
future doesn't even exist, right? So
That's
uh,
right.
look at this as
Yeah.
a hedge so that you can
Yeah.
continue existing. So when you
Correct.
tell me, Paul, why do we even want to do this? Well, you might want to have an
Hmm.
existential hedge,
Yeah.
and consider adjacent verticals, even tangential, or even something totally unrelated to your a company,
Hmm.
just in case, uh, something like what happened in the pandemic, which is we all know happened. No, we saw a lot of companies uh,
Hmm.
just destroyed, right, overnight. But the good thing is, for example, DTA just said 2 million new e-commerce companies were created in the last 2 years, which is crazy. Like, so that
Yeah.
means that 2% of Filipinos suddenly overnight became digital entrepreneurs,
Yeah.
technology
Vendors.
entrepreneurs. So there is a good side. There is an
Hmm.
outsized return on that side of the fence, but that meant being ready or being able to embrace chaos, right? That's what they say, chaotic, right? The
Hmm.
ability to live at the edge of where chaos meets order,
Yeah.
the chaotic boundary. So this is, I think, what Bifan and Embiggen offers for you to have a fighting chance, to have an existential hedge, given that these
Hmm.
tail events that we thought was a black swan, this is not really black swan.
Yes. It's not part even of VUCA, eh. Ano bang tawag diyan? It's
Yeah,
ano,
yeah.
not
You
really
probably have to
unplanned event,
factor
yeah.
in your business continuity planning that these things
Yes.
are probably not in one in a million. There's
Yeah.
probably like 1 in 100 chance of happening. So
Right, right.
if you approach this with open eyes, and this is something you
Mhm,
think worthwhile in your modeling, then
mhm.
of course then consider this kind of interventions.
Yeah. But just to finally add to what Roland and Paul said, no, I think, I mean, C-level guys now really have to think with all of this, external, volatilities, uncertainties. But, in my mind, it's really now a question of when. It's not really, a question of it will happen or when will it happen, right? So, for example, guys are now really doing stuff in the metaverse. There's Web3 developments. I think it's just really a question of when, right? So, I mean, for the C-level guys listening here, they should also be cognizant of their own companies being able to participate in all of these changes. And I guess through putting up your own fund or your VC, will allow you to see all of these potential opportunities, right? To future proof, or to Paul's point, you're not even sure, right, if you have a future, because if you stick to your focus in terms of your existing business or your core business, right, and you don't continue to innovate, then that's really detrimental to your business. So hopefully you consider venture building or setting up this VC with the right partners.
All right. So again, thank you so much for this discussion, Roland, Paul, and RJ. So that concludes our panel discussion for this day. If you have any questions, please feel free to put them on the chat, and we'll now open the floor for questions and answers. So thank you.